Let's get in Guy Stear, who is the head of research for Asia Pacific at Societe Generale. He joins us right now from Hong Kong. Good having you, Guy. Thanks so much for joining in. Some would call it a surprise, some would call it on expected lines. But what did you make of the announcement from the EU yesterday? And how positively could it augur for the global markets at large?
Well, I think there are some things which were broadly as expected and some things which were a little bit surprising. The things which were broadly as expected were the moves in terms of interest rates. So a rate cut was broadly expected, and amongst people in the markets at least, although there's been quite a lot of talk about it in the press, it was expected that they would move the ECB deposit rate to negative territory. What was more surprising was the LTRO, the new financing discussions, although we did get some hint that this would be coming last week from Mr. Draghi when he talked about targeted financing facilities for banks which do lend to corporates. The size of the program was a bit surprising. And I think the other thing is the maturity of the program was a bit surprising, with the money being lent out to 2018. That was quite long and indeed quite supportive in terms of the market. So the immediate reaction was good. I think we definitely saw bond markets selling off, but then they bounced up again. And I think some of the questions that people are asking right now is to say, well, will this program actually work in the medium term? Because it does rely on the banks actually asking for the money. One of the great difficulties have been that banks have felt that they didn't want to do that much more lending, and they may still feel that, so they may turn around and not ask for the money. So it's a little bit of an issue that the ECB is still dependent on the banking system working properly in order for this plan to function.
Guy, hi, morning. This morning, though, there seems to be some nervousness and caution amongst the Asian equities, at least, ahead of the US jobs data. What's expected?
Well, the consensus is for a print of around 215,000. Our own view amongst our US economists at Societe Generale is that we should see a slightly higher figure than that, around 240,000. One of the things which is striking is how wide the range of consensus forecasts is at the moment. I think there are some people who are looking for figures even slightly below 100,000, and some people who are looking for figures above 300,000. And I think that's adding to sort of the nervousness of the market, that we do see a sort of uniquely wide or unprecedentedly wide range going into these figures, a lot of uncertainty about just what they could bring out.
Guy, I don't know how closely you track Asia, but a lot of people that we spoke to over the last 2 months have stated that even if the US markets continue the QE taper, it will probably not have as dramatic an impact on India as it had maybe 12 months ago. That coupled with the stable domestic government that we have. What's the view on India now?
Well, I think that's absolutely right. I think the whole debate, even in the US and for the developed markets, has moved on from tapering to the question about interest rates. And what we've seen since the beginning of this year is much more optimism about when interest rates will start to go up, how slowly interest rates will rise. So as a result, we've seen a pullback in terms of 10-year bond yields of almost 40 basis points since the beginning of the year. Now, that is somewhat reversed in the last week and a half. We're back almost to the middle of the range we've been trading at since the beginning of April. But it's a little bit difficult to say what impact things would have on emerging markets in terms of U.S. rate policy, because the moves in U.S. 10-year yields this year have so far been very favorable for emerging markets, because yields have actually gone down.
Okay. Guy, the other bit is, yesterday also, while the markets cheered the ECB move, Germany, for example, raked in profits as well, because a few people believe that the moves are not as dramatic as people probably envisage them to be. Does the EU move and the commentary negate any kind of fear that markets may have with regards to US QE taper?
Well, I think the markets, again, are not so focused on tapering per se, but they're much more focused on what kind of commentary could come out about US rates. I think what you say about global monetary policy is very true. On the one hand, we have a Bank of Japan that is still trying to pump money into Japan, and some of that will leak out to other markets. We have an ECB that is trying to pump money into Europe, and some of that will leak out into other markets. We have a sense that the U.S. is now reducing the liquidity in the market. That's true with tapering, that eventually U.S. rates will go up. So US monetary policy will be tightened, I think that the balance of all these factors for emerging markets is somewhat more positive. And indeed, our view from about 2 months ago has been we've reweighted and increased our allocation to emerging markets because we do think, in some sense, they are less sensitive to simply US monetary policy than they might have been thought at the beginning of this year or at the end of last year.